It's a fear every investor shares, waking up one morning to find your savings slashed, your investments in freefall. A full-blown financial crisis. You know the big ones. The 2008 housing collapse, where mortgage debt blew up the biggest bubble the world had ever seen, or the crash that triggered the Great Depression, leaving 1 in 4 Americans unemployed. But here's the thing. These crashes don't come out of nowhere. They leave fingerprints. There are always 4 consistent, clear signals that appear before the bottom drops out. And if you know what to look for, you can prepare. To understand this, let's go back 400 years, way before computers or Wall Street, to 1634 in the Netherlands. Because the psychology of a crash hasn't changed. It was the Dutch Golden Age, a time of massive wealth, and they were ready for the world's first documented crash, tulip mania. And that brings us to the first pattern, rampant speculation. Back then, the tulip flower became a status symbol. People started paying insane amounts for rare bulbs. At its peak, a single tulip could cost 5 years of an average salary. That's like paying $200,000 for a flower today. Here's where it got weird. People weren't trading the actual flowers. They were trading futures contracts. They were just flipping paper, confident they could sell it to the next person for a higher profit. Overconfidence. It was the irrational exuberance stage where everyone ignored the risk. Like that satirical pamphlet from the time said, "Many a plowman has high hopes when he sows his grain, and all he reaps is stubble." That same pattern shows up again and again. Now, let's jump forward a few hundred years, right before the biggest crash in history, 1929, to reveal the second pattern. This one's about the people in charge. It's about a regulatory shortcoming. In the 1920s, the market was growing faster than the guardrails. New financial companies were invented, leveraged investment trusts, that used debt on top of investor money to make bigger bets. The common wisdom was, markets always go up. And the government? They barely acted at all. President Coolidge even said, "The chief business of the American people is business." It was the ultimate hands-off, laissez-faire era. The big banks piled on debt, their funds traded at double the value of their actual stocks, and everyone thought they were a genius. When the market finally collapsed, dropping 89%, it wasn't just a correction, it was a devastating depression. The lesson? The balance is tricky. Regulators either stifle growth too early, or they wait too long and allow instability to build. For the third pattern, let's fast forward to the 1980s. The rise of computers allowed big banks to invent totally new financial products. This is where we see the third ingredient, a new, poorly understood innovation. In the 80s, that innovation was called portfolio insurance. The idea was simple. A computer program would automatically make small trades betting against a stock if the market dropped, limiting your losses. Like a seatbelt for your investments. Sounds great, right? But the system was complex, so complicated that no one fully understood the risk. When the market started to slide in 1987, those computers all began selling at once, exactly as they were programmed to. The small trades became a massive, high-speed avalanche. The flaw everyone overlooked? That sometimes, human panic means the math doesn't matter. The result? Black Monday, the worst single-day drop in stock market history. Now, for the final ingredient, the one that amplifies everything else, and the one that broke the system in 2008, the buildup of debt. After the dot-com crash, investors wanted safer things. The banks delivered the ultimate Frankenstein security, mortgage-backed securities. They handed out mortgages to anyone with a pulse, packaged the risky loans, and sold them to investors. Why? Because debt levels were soaring. Everyone believed housing prices couldn't fall. It had to be different this time. But when people started defaulting, the debt-fueled structure collapsed. Lehman Brothers fell. The global economy froze. The sheer amount of borrowed money in the system turned a housing correction into a crisis that decimated entire neighborhoods. History doesn't repeat itself, but it certainly rhymes. The next crisis will look different, but the patterns will be the same. When you look at the market today, ask yourself, Are people buying assets without considering their actual value? Are regulators struggling to catch up with a new industry? Is there a new innovation nobody fully understands? And most critically, is the whole system leaning too heavily on borrowed cash? The fear is real, but knowledge is power. The best way to prepare is to focus on what you can control. Don't sell in a panic, and most importantly, position yourself to invest when others are selling. Crashes put everything on sale. Be ready to buy. If you found this breakdown helpful, hit that like button and subscribe for more deep dives.